Okay, so the first standard that we are going to look at is known as International Accounting Standard 23. International Accounting Standard 23. Now, IAS 23 talks about borrowing costs. Borrowing costs. Now, what about borrowing costs? Borrowing costs is basically the cost of financing a business. For example, if I approach a bank and they give me a loan, borrowing cost is not the loan that I receive, but the interest that will be paid on the loan that has been received. So when we talk of cost of borrowing, this is the interest that is being paid. It's not the amount that is being borrowed, but rather the interest that is being paid. It's not the principal, but the interest. So what does borrowing costs include? Borrowing costs includes interest on loans, be it bank overdrafts or just normal loans. And it may also include amortization of discounts and premiums on borrowings. And these will be looking at it in financial instruments. It may also include finance charges on finance leases, and these will cover it in a standard called IFRS 16 on leases. Point number 2, amortization of discounts and premiums on borrowings will cover it under a standard called IFRS 9 financial instruments. Finally, it may also include exchange differences on foreign currency borrowing. When we borrow in foreign currency, the exchange differences are also part of borrowing costs. So basically, borrowing costs, let's just have it as the return on the funding, on the loan, the interest that you pay. It's not the principal, but rather the interest that is paid. We expect the class to be quite big, and I'll be muting everyone. After every 5 minutes, I'll be checking on the chat section if there is any question that is there. But in order to manage the class is quite huge. I must mute everyone so we can continue. Now, every standard must have an objective. So what is the objective of IAS 23? The objective is basically to give the accounting treatment of borrowing costs. How should we account? Once we have identified borrowing cost is XYZ, how should we account for these borrowing costs? Should we take it to the income statement or should we take it to the balance sheet? So the objective is to prescribe the accounting treatment of borrowing costs. Once you found it, where should you treat it? Where should you recognize the borrowing cost? That is basically objective. Now, how do we recognize borrowing costs? What is to recognize? To recognize is to include an item to the financial statements. Now, in this case, how should we include the borrowing costs in financial statements? Now, borrowing costs should be capitalized as part of the cost of an asset for a category of assets known as qualifying assets. Now, this interest on loan, think of when we are referring to borrowing costs, to enable us understand it, think of you have borrowed a loan. How do you account for the interest on the loan? Now you are being told for this interest or for this borrowing cost, you should capitalize it only if it's a qualifying asset. Now, what is to capitalize? To capitalize is to recognize borrowing costs as part of the cost of an asset. In other words, to recognize borrowing cost as a non-current asset, because non-current assets go to the balance sheet. So, for example, if it's interest you paid on a loan that you used to construct a house. So that house, once you construct it, you add all the costs you incurred to construct the house, and then also you add interest on the loan you borrowed to finance the construction of the house. In other words, you are capitalizing it. So borrowing costs should be capitalized for qualifying assets. I think this is different from what we know. We normally know that interest is an expense, but now in IAS 23, we are saying that some interests are not expenses. Some interests are non-current assets, are capitalized. Now, we have said we capitalize borrowing costs only for qualifying assets. Now, the question is, what are qualifying assets? When we talk about a qualifying asset is an asset that takes a significant period of time to be ready for use. An asset which takes a substantial period of time to get ready for use. In other words, an asset that if you are constructing, it will take you a significant period of time. Anything that is in excess of, the standard does not dictate the period, but anything that is in excess of 6 months, that is a significant period of time. So any asset that can take you more than 6 months to finance, to construct, it's a qualifying asset. So note that a qualifying asset is an asset that takes a significant period of time to be ready for its intended use. Now, if there is borrowing costs on this type of an asset, we normally capitalize the borrowing cost. What is capitalization? To capitalize is to include it in non-current assets. So these interests, if it's for a qualifying asset, you include it in as part of the cost of the asset. In future, we will look at IAS 16, property, plant, and equipment. So once you've calculated the cost of an asset, remember to add borrowing costs to it if it is to be capitalized. Now, for assets that don't meet the category of qualifying assets, in other words, for assets that do not take a significant period of time to be ready for use, those are non-qualifying assets. So for non-qualifying assets, borrowing costs on them should be expensed. As I leave this slide, I'm saying this. For qualifying assets, capitalize borrowing costs. For non-qualifying assets, expense the borrowing costs. For qualifying assets, take the borrowing costs to non-current assets in the statement of financial position. For non-qualifying assets, take the borrowing cost to the income statement as an expense. Let's move a step further. Now, capitalization of borrowing costs has got a time that it starts and it has got a time that it ends. In other words, commencement means that at what point do we start the capitalization? So when we talk about capitalization, capitalization has got a time that it starts and it also has got a time that it ends. The starting of capitalization is known as commencement of capitalization according to IAS 23, International Accounting Standards 23. So capitalization of borrowing costs should commence when three conditions, any of the three conditions are met. If you have a question, you type it in the chat section. Every 5 minutes, I'll be reading the questions. So when does capitalization start? If any of the conditions are met. Number one, expenditure on the asset is being incurred. So yes, you have borrowed a loan, you want to use it to finance construction of a qualifying asset, and you have already started spending. Expenditure on the asset is already being incurred. Maybe you've already started purchasing some materials, you've already started procuring labor, etc. That is expenditure is being incurred. So immediately there is the start of expenditure, you should also start capitalization of borrowing costs. Point number two, borrowing costs are being incurred. You financed the construction through a loan and you have already started repaying the loan, both the principal and interest. If there is evidence that you have already started repaying the loan, in that case, you should also start capitalization of borrowing costs. And number three, activities that are necessary to prepare the assets for its intended use or sale are in progress. Maybe you have already started transporting goods to the site where the construction is done. You have started already clearing the site. You've started delivering materials to the site. Those are activities that are necessary to prepare the asset for its intended use. There are three conditions that are met for capitalization to start. Condition number one, expenditure on the asset is being incurred. Condition number 2, borrowing costs is being incurred. And condition number 3, activities that are necessary to prepare the asset for its intended use are in progress. Now, let's go to the chart. Richard is asking, non-qualifying costs are taken to income statement. Yes, borrowing costs incurred on non-qualifying assets are expensed. To expense is to take it to the income statement. So long as it's non-qualifying, it doesn't take a significant period of sale to be ready for use. James is asking, we have some charges that are paid when we have not paid the interest on time. How do we treat that? We are not referring to penalties in this case, James. We are only referring to the interest that is paid. So penalties, those ones will be expensed. Penalties will be expensed. We are only referring to the interest. Again, let's minimize the number of questions. Maybe the last question, can you come again where qualifying costs are taken? Borrowing costs that are incurred for qualifying assets are taken to the balance sheet as non-current assets. They are added as part of the cost of the asset. For example, if you are constructing a house and this house meets the definition of a qualifying asset and you have spent 10 million to construct this house and there is an interest on the loan of maybe 1 million, you will take the cost of the house of 10 million and you add the interest you paid on the loan to finance the house of 1 million. Therefore, the total cost of the house will not be 10 million that you incurred. It will be 10 million plus the 1 million, which was an interest on this asset, which is qualifying asset. Can we move on now? So we have said there is a time that capitalization starts and there is a time that capitalization stops. Capitalization starts when expenditure for the asset is being incurred. Number 2, when the borrowing costs are being incurred. And number 3, when activities that are necessary to prepare the asset for its intended use or sale are in progress. Now, when does capitalization stop? IAS 23 refers to cessation. Cessation is an end of something. Cessation is when something comes to an end. The stop, when something stops. In that case, we refer to it as cessation. So when does capitalization stop? Immediately capitalization stops, expensing starts. I hope we are together. When we stop capitalization, we start the process of expensing. So when does capitalization stop? Capitalization stops under 2 conditions. Number 1, when construction is complete. If you are constructing an asset, immediately the asset construction is complete, we should stop capitalization. Immediately it is complete. Point number 2, when construction is suspended. Maybe the government will come and do inspection in your site and find that you did not comply with some condition. And the government suspends your construction for maybe 1 month. During that period that your construction is suspended, you should not capitalize in that period. In that period, you should expense interest. You should expense the borrowing costs. So borrowing costs, capitalization stops when, number 1, construction is complete. That is point number 1. Substantially all activities necessary to prepare the asset for its intended use are complete. And number 2, when construction is suspended. So maybe if you are to construct for a period of 1 year, and out of the 1 year, the construction was suspended for 2 months. During these 2 months, you should not capitalize the borrowing costs. This is normally a common question in exams. You can be asked, when does capitalization start? There are 3 conditions. When does capitalization stop? Under 2 conditions. Now, what should you disclose under IAS 23? To disclose is just what should you record in borrowing costs. Number, the amount of borrowing costs capitalized. So you should disclose how much you capitalized as borrowing costs. Point number 2, you should also disclose the capitalization rate that was used. What was the percentage of interest rate that was used? If it is prorated, you also show the amount that was prorated. So number one, you should show the amount to be capitalized. And number two, you should show the rate of capitalization in this case. Now, okay, somebody's asking a question. Let me read it. Mugisha Gad, I think you have come late for class. What is capitalization? That is what I started with, Mugisha. Capitalization is the treatment of borrowing costs as part of the cost of an asset. Capitalization means you take the borrowing cost to the balance sheet as part of the cost of an asset. You take it as a non-current asset. So you calculate the cost of an asset and you add the interest you paid on the loan. In that case, we say when you take this interest to the balance sheet as an non-current asset, in that case, we refer to capitalization. Expensing means taking it to the income statement. I hope I've clarified that, Mugisha. So let's move on. So that is what we have basically in our introduction. Finally, the last point before we look at a number of examples, we have quite a number of examples to help us understand the concept of capitalization. So note that now, if you have borrowed a loan, let me explain this note too. If you borrowed a loan of maybe 1 million and the interest per annum on the loan, the interest per annum is 10%. So 10% of 1 million is 100,000. Now you should check this 1 million that you borrowed, you may not use it. You may not use it at once. Maybe you borrowed 1 million in January. Okay, Eliab is asking, why do we only focus on interests? The standard looks at interest. The standard looks at borrowing costs. And I gave other examples of borrowing costs, like finance charge in finance leases. I said exchange differences when we are borrowing in foreign currency. I think I gave a number of examples. It's just that maybe you came late for the class. Okay, so let's move ahead. So we were saying that, for example, if you borrow and the interest on the loan is 10%, and the loan was borrowed in January, but you will not use the entire 1 million in January. Gloria, just log out and log in. I'm having a second projection, which clearly shows me that projection is accessible. So just log out and log in. Okay, let's move on. So we are trying to say when you borrow some loan, there is the interest and you are not using all the money at once. You may be investing part of the money you are not using. For example, if I borrow 1 million from the bank to construct a house and I borrowed in January and construction will take 12 months, prudence dictates that you should invest some of the funds that you are not using immediately. So if you invest part of the funds you borrow, which you are not using immediately, the returns you generate from these investments reduces the amount of borrowing cost to be capitalized. Let me repeat. When you borrow a loan, there is an interest you are to pay. This interest, if it is for a qualifying asset, we have said you capitalize it. What is to capitalize? To capitalize is to take it or to treat it as part of the cost of an asset. Now we are saying that if you borrow an amount and you are not using the entire amount immediately, what you are not using, you may invest it. If you make an investment and that investment generates you some return, the return you get from the investment reduces the borrowing costs to be capitalized. For example, you have borrowed 1 million. The interest on the loan is 100,000, but you invested part of the proceeds from the loan and the proceeds generated you 30,000. The interest was 100,000. The proceeds from the investments are 30,000. So you take 30,000 and you minus it from this interest of 100,000. What you remain with is 70,000. This 70,000 is what needs to be capitalized. So I've put that in a note. Let's read the note in the projection. If the borrowed funds are used in other investments before being capitalized, we have to reduce the interest payable by the return from those investments. So if there is any investments you made and it generated you some return, before you calculate the amount to be capitalized, you calculate it, but you reduce it by the returns you generated. The net amount is what is to be capitalized. So in short, in summary, what have we looked at? Number one, we have looked at examples of borrowing costs. Examples of borrowing costs: interest on loans, be it short-term or long-term, be it long-term loans or be it overdrafts. Number two, we also said maybe finance charges on finance leases. We talked of exchange differences if borrowing is in foreign currency, etc. And then we have looked at how should we recognize borrowing costs. We have said borrowing costs should be capitalized for qualifying assets, and borrowing costs should be expensed for non-qualifying assets. So for qualifying assets, borrowing costs should be capitalized. For non-qualifying assets, borrowing costs should be expensed. What is a qualifying asset? A qualifying asset is an asset that takes a significant period of time to be ready for use. An asset that takes a significant period of time to be ready for use. And then we have said, when does capitalization starts? What we call commencement of capitalization. Capitalization starts when three conditions are met. Expenditure on the asset is being incurred, borrowing cost is being paid, and number three, activities that are ready to prepare the asset for use are in progress. We have also looked at, when does capitalization stop? Capitalization stops under two conditions: when construction is complete, and number two, when construction is suspended. Finally, we have said that if you made some investment from the amount you borrowed, the return from this investment reduces the amount of borrowing cost to be capitalized. Let's have some few examples. So I'll be having a number of examples. I'll read through all the examples. I'll read through all the examples, and then kindly, James, the class is too big. You can even see we have more than 100 participants. Please, if we have more than, it's difficult to manage the class. So let's please stick to the chat. Some loans are long-term and paying annual interest. We add no. When we talk of, in this case, financial statements are prepared per annum. So when we talk of capitalization, we talk of capitalization per annum, not for 25 years, only for that year, not for a long period of time, only for that period, because loans are paid per annum. So when we are looking at the amounts to be capitalized, we look at per annum. Allow me to go to questions so that we manage our time effectively. Example number one reads, on 1st January 2005, ABC Limited began to construct a supermarket which had an estimated useful life of 40 years. The company purchased a leasehold interest in the site for $25 million. The construction of the building cost $9 million, and the fixtures and fittings cost $6 million. The construction of the supermarket was completed on 30th September 2005 and was brought into use on 1st January 2006. ABC Limited borrowed $40 million on 1st January 2005 in order to finance the project. The loan carried interest of 10% per annum, and it was repaid on 30th June 2006. Required, calculate the total amount to be included at cost in the property, plant, and equipment in respect to the development at 31st December 2005. So that's the first question we'll focus on. There will be example 2, which I'm not reading until we reach it. There is also an example 2 that is a different set of a question. There is example 3, which is from the past papers. There is example 4, which is also from a past paper. There is example 5, which is from a past paper, and I've quoted the past paper. And there is also example 6, which was from this year. So from this year, April sitting. So we have 6 examples. Our time can only enable us to cover 3 examples, and I'll choose examples that have got different scenarios, which are not related. Okay, let's move on to Excel sheet so that we solve example 1. So we are going to example 1. Let's read it once more before I go to Excel sheet. On 1st January 2005, ABC Limited began to construct a supermarket which had an estimated useful life of 40 years. The company purchased the leasehold interest in the site for 25 million. The construction of the building was 9 million, and fixtures and fittings costs were 6 million. The construction of the supermarket was completed on 30th September 2005 and was brought into use on 1st January 2006. ABC Limited borrowed 40 million on 1st January 2005 in order to finance the project. The loan carried an interest of 10% per annum, and it was repaid on 30th June 2006. Required, calculate the total amount to be included at cost in the PPE in respect to development at 31st December 2005. So at the end of 2005, we need to calculate the amount of borrowing costs to be capitalized. So let's go to Excel. So it's the same question. I've now projected it in Excel. So the question was read on 1st January 2005. So 1st January 2005, ABC Limited borrowed a loan or began to construct a supermarket. Of course, construction of a supermarket will take a significant period of time, and the useful life of this asset is 40 years. And then we are being told the company purchased a leasehold interest in the site for 25 million. The construction of the building was 9 million, and fixtures and fittings costed 6 million. The construction of the supermarket was completed. I've highlighted the date of completion, and was brought into use on 1st January 2006. ABC Limited borrowed 40 million. So when we are starting to look at this question, we must start by looking at, first of all, how much was borrowed. So in our solution, we'll be looking at amount to be capitalized. So maybe that is the amount to be capitalized. Now, in order to get the amount to be capitalized in this question, how much did we borrow? We borrowed 40 million. So 40 million was borrowed. And the interest on the loan was 10%. But remember, we are looking at the amount to be capitalized, to be treated as part of cost of the asset. We borrowed 40 million at an interest rate of 10%, but remember, capitalization stops when construction ends. Immediately construction ends, capitalization stops. You will not capitalize for the whole year because construction, this paragraph here, the construction of the supermarket was completed on 30th September 2005. So which means construction began on 1st January and it ended on 30th September. From January to September, those are 9 months. So you will prorate it to 9/12 because capitalization stops immediately construction ends. So in that case, the amount to be capitalized, you take the 40 million times 10% times 9 divided by 12. So we get 3 million. 3 million is the amount to be capitalized. So this amount of 3 million is the amount that goes to statement of financial position as part of the cost of the asset, as a non-current asset. So remember, why did I multiply by 9/12? Because capitalization, from what we read in the slides, capitalization stops when construction is complete. Construction was complete on 30th September. Immediately the construction is complete, we should stop capitalization and we expense the remaining interest. Therefore, I need to ask amount to be expensed. Borrowing costs to be expensed. What is the borrowing cost to be expensed? Remember, this is, let me just write it in full. Borrowing cost to be capitalized was the first one. Now we are looking at the amount of borrowing cost to be expensed. You will take 40 million, you multiply it by 10%, and then you multiply by 3 months that are remaining until December, 3/12. So that will give you 40 million times 10% times 3/12. So that is 1 million. But we have not been asked, but we can be asked, what is the total borrowing costs? In other words, what is the total interest? The total borrowing cost is equals to the 3 million plus the 3 million plus the 1 million. So the total borrowing cost, in other words, the total interest is 4 million. Out of the 4 million, how do you get 4 million? 4 million is simply 10%. 10% without prorating it. So the total interest is 4 million. Out of it, 3 million goes to the balance sheet and 1 million goes to the income statement. So this one goes to income statement as an expense. It goes to the income statement as an expense. So we have that goes to the income statement as an expense. Let us move on. Now, what amount exactly goes? What amount goes as the cost of the asset? We, number 3, need to calculate the cost of the asset. Cost of the asset. Now, when you want to calculate the cost of the asset, when you want to find the cost of the asset, you add everything you spent. The company purchased a leasehold interest in the site for 25 million. So purchase of leasehold interest. Purchase of leasehold interest was 25 million. And then you are being told the construction of the building cost 9 million. Construction of building. Construction of the building, sorry, that is a G. Construction of the building cost 9 million. Number 3, fixtures and fittings cost 6 million. Fixtures and fittings cost 3 million. Sorry, 6 million. Fixtures and fittings cost 6 million. Okay, and then there is, you add to that, add borrowing costs. Borrowing costs, that is now what we have learned in the standard, to be capitalized. The amount of borrowing cost to be capitalized, you add it to it. The amount of borrowing cost to be capitalized, we have calculated it above here. So you remember to include the amount of borrowing cost to be capitalized, which is 3 million. So what is the total cost of the asset? Total cost of the asset is equals to, you add up everything there. The total cost of the asset is 43 million. If we did not have this standard, we could have taken the cost of the asset as 40 million. If this standard IAS 23 was not there, we could have taken the cost as 40 million. We could not have accounted for what is to be capitalized. What is to be capitalized, we could have taken it to the income statement, the whole of it as an expense. But because of the standard tells us borrowing costs should be capitalized, and therefore this is the amount to be capitalized. The amount to be capitalized. And then this is the total cost of the asset. Let me again once more look at questions. Earlier, why do we only focus on interest while during payments we will pay principal plus interest? Earlier, principal, you know how to account for it. Unless principal amount goes to the balance sheet as a non-current liability. Earlier, we are not discussing non-current liabilities because the principal goes to the balance sheet as a non-current liability. We are looking at the interest, and what we are learning today is that there is an interest that goes to the balance sheet as a non-current asset as part of the cost of the asset, and there is another interest that goes to the income statement as an expense. We are not focusing on the principal. Principal goes to the balance sheet as a non-current liability. I hope that is clear. Not able to see the presentation. Okay, I think we have, you can rejoin. So a qualified asset takes 6 months and above, or even if it take 1 month. I think I've already explained that the standard is not clear, Gilbert, on the period of time. But I've said, so long as the question says it's a significant period of time. The 6 months was just an example I gave out. You should now use your reasoning to decide if it's a qualifying, but the questions will always tell you it took a significant period of time to be ready for use. It took a significant period of time to be ready for use. So repeat how you got 1 million. What is the full word for what? Pascal. IAS is International Accounting Standard. Okay, so let's move on. I said 1 million. The interest was 10% of 40 million. 10% of 40 million is 4 million. But capitalization was starting from January until when it stops in September. The interest that is paid after September, October, November, and December, that is the one to be capitalized. October, November, and December, after capitalization has stopped. Can you please allow me to go to another question so that we have a number of questions together? We must finish this standard today. So another question. So there is a second question, which is a different scenario setting of a question. Let's be attentive in it. Example 2. And an example like this was tested in April 2023 sitting, but I will give it as an assignment. So let's read this question. On 1st January 2006, ABC Limited borrowed 2.1 million. This is from your notes. Example 1 from your notes. Example 1 from your notes. On 1st January 2006, ABC Limited borrowed $2.1 million to finance the construction of an asset, A and B, which qualified to be qualifying asset. So you can see in this case, the examiner has told you it's a qualifying asset. The construction commenced immediately, but only part of the funds were allocated to the construction. So these guys borrowed 2.1 million. Construction began immediately, that is on 1st January 2006, but they did not use the entire 2.1 million. The construction commenced immediately, but only part of the funds was allocated to the construction. The interest payable on the amount borrowed was 12%. The invested surplus realized a surplus return at a rate of 6%. Let me explain. We borrowed 2.1 million to finance construction of two assets, asset A and asset B. The interest that was paid on the 2 million was at a rate of 12% per annum. Because we did not use the entire 2.1 million in January, any amount that was not used in January was being invested. And when we invested it, the return on investment was 6%. What did we say? Any return on investment reduces the amount of borrowing cost to be capitalized. So the return from 6% will reduce the amount of interest to be capitalized. So let's look at the usage or allocation of the 2.1 million. So remember, 2.1 million was borrowed to finance the construction of asset A and asset B. Now, asset A took a total of 700,000. Asset B took a total of 1.4 million. So when you take 700,000 plus 1.4 million, it gives you 2.1 million. So how did we use the funds? Let's start with asset A. Asset A used a total of 700,000, but the amounts were allocated to the two projects as follows. On 1st January, in other words, at the beginning of the year, we allocated 400,000 out of 700,000 needed to finance project A, asset A. Now, on 1st October, we again used the remaining 300,000. You know, when you are constructing a house, you don't use all the amount immediately. The amount is used in stages. Maybe what you will be using for roofing, you will use it later on 1st October. So that is an example of here. Immediately we started construction, we only needed 400,000. I'm only in asset A. Now, I'm only using asset A, and then later on I'll explain asset B. I'm seeing somebody's asking a question from what we have finished. On which basis the 3 months, the 3 remaining months were charged to income statement, yet no. What do you mean by not consumed, Richard? I'm not getting you in that question. We are just saying that immediately capitalization stops, expensing starts. That is what we learned, unless you missed the beginning part of the class. Immediately capitalization stops, expensing starts. So that question, we are already done with it. Immediately capitalization stops, expensing starts. So let's not mix it up with this question. It will bring a lot of confusion. Let's finish this. If you have another question, we can go back to it. So compute the borrowing cost to be capitalized for each asset and the total cost of each asset, assuming the construction was completed on 31st December 2006. So point number 1, construction was completed at the end of the year. Construction was completed at the end of the year. So entire borrowing costs need to be capitalized if there was no investment return. I'm repeating, the entire borrowing cost needs to be capitalized because construction began on 1st January 2006 and it ended on 31st December, end of the year. So the whole borrowing costs need to be capitalized only if there was no investment return. But remember, we made an investment at a rate of 6%. So the return we get from such an investment needs to reduce the amount to be capitalized. So in order to answer this question, we will start with asset A. In order to answer the question, we will start with asset A. Now, for asset A, the total amount was 7 you can see here the total amount was 700,000. So for asset A, total interest, total borrowing costs. In other words, total interest. For asset A, the total borrowing costs is 700,000, which was borrowed for asset A, times the interest rate. Our interest rate is 12%. So times 12%. So in that case, the total interest is, we can put it there, 700,000 times 12% was the interest. So the entire borrowing cost is 84,000. Now, if we did not, this borrowing cost of 84,000, it meets the definition of the amount to be capitalized, but we did not use the whole amount immediately. We used only 400,000 for asset A on 1st January. Now, which means the other 300,000, we only needed it on 1st October. Now, if we were in need of it on 1st October, I'm repeating this. Let me be very slow so that you get it. On 1st January, we only used 400,000 out of 700,000. The remaining 300,000 was to be used on 1st October. Now, what does that mean? Between 1st January and 1st October, there is an amount that was not used. The amount that was not used was 300,000. Instead of leaving this amount to be idle in the bank, you need to invest these 300,000 until the day you will use it. So because you are using it on 1st October, you can invest it from 1st January. You can invest this 300,000 from 1st January to end of September. And we were told investment surplus realized are at a rate of 6%. So you come and we said the last note, if you remember the last note in the slides, if there is any investment, the return from the investment reduces the amount of borrowing cost to be capitalized. So you less investment return. And the investment return is at a rate of 6%. So we invested 300,000. 300,000 is the amount we were not using immediately at a rate of 6%, and we invested it from 1st January to 1st October. How many months are those? 9/12. Now, immediately we reach 1st October, we withdraw the money from investment and then we use it to construct. So the return from investment reduces the amount to be capitalized. So what is the return from the investment? You take the 300,000 times 6% times 9/12. Now, this gives you now borrowing cost to be capitalized. Borrowing cost to be capitalized. So what will be the borrowing cost to be capitalized? 84,000 minus 13,500. So it gives you 70,500 is to be capitalized. I'm repeating for the sake of clarity. The total borrowing cost is 700,000. I'm for asset A, not asset B, asset A. I'm in asset A. The total amount borrowed for asset A was 700,000. The interest that was being paid on it was 12%. So I took 700,000 times 12% to give you 84,000. Now, out of the 84,000, we made some investment, and we said any investment return should reduce the amount to be capitalized. So the investment return 300,000 was not being used immediately, was not being used on 1st January. It was being used from 1st October until December. So between 1st January up to the end of September, we were not using this 300,000, and therefore we can invest it. Because we can invest it, the investment will generate a return of 6%. So the return generated from the investment helps to reduce the amount to be capitalized. So this one gives you the borrowing cost to be capitalized. It is the total borrowing cost minus the investment return. And then now we need to find the cost of the asset. Cost of asset A. So what is the total cost of the asset? The total cost of the asset will be the amount spent in cost of construction cost, the total amount that was spent in construction, which was 700,000. And then to it, you add borrowing cost to be capitalized. You add the amount of borrowing cost to be capitalized. And we found that it is 7,500. So this will be the total cost of asset asset A. This total cost of asset A is what is now to be taken to the balance sheet. So the total cost of the asset that will be shown in the balance sheet is 770,500. You remember, you take the cost of the asset plus the amount only to be capitalized. I'm seeing a number of charts. Where is investment return affect? Okay, please rephrase your question. Where is investment return affect in income statement? This amount of investment return only reduces the amount of borrowing costs, only reduces the amount of borrowing costs, only reduces the amount of borrowing costs. And this part of the investment will be expensed. So the answer to that is it goes to the income statement as an expense, whatever we have deducted. It's the amount to be expensed. I'm seeing, why are we multiplying with 9 over 12? Yet the return, we are not told it's annually. Okay, I'll answer that, but I think I've explained that over and over. Let me read another question, sir. Maybe you mistaken for 300,000 instead of 400,000. No, I've not mistaken it, Donat. I'll explain that. I've not mistaken. Will these workings be shared to us? Yes, I will share the workings. Okay, I'll share the workings. Okay, so let's look at this again. Please, let's refocus on it. Although now we are taking more than the time we had planned. The total cost of constructing asset A was 700,000. So out of the 2.1 million, 700,000 went to asset A and 1.4 million went to asset B. When you add 700,000 plus 1.4 million, it gives you 2.1 million. So 700,000 was used to finance asset A and 1.4 million was used to finance asset B. Now we have started with asset A. The amount borrowed for asset A was 700,000. The interest paid on this amount is 700,000 times the interest rate of 12%. So that is what I've said there. The total borrowing cost is 700,000 times 12% to give you 84,000. Now there is a question I was asked here. Now we said that we, out of this total of 700,000, we only used 400,000 at the beginning of the year. On 1st January 2006, we spent only 400,000. So 400,000 was used immediately. But there is a 300,000 that was not used immediately. So the amount you don't use immediately, don't leave it idle in the bank. invest it in a safe investment which will generate you some return. Because we will need the money on 1st October 2006, we can invest this money from 1st January until 30th September. And then on 1st October, we can use it. So that is what I'm saying. This 300,000 was only needed on 1st October. It was not needed between 1st January and 30th September. So in this period that it was not needed, you can invest it. And this period that it was not needed is 9 months from 1st January until a day before this. A day before this is 30th September. So how many months are those? Those are 9 months. And we invested it at a rate of 6%. So 300,000, which was invested for 9 months because it was not being used immediately, at a rate of 6% for only 9 months, gives you a return of 13,500. And the standard, the last slide on the standard told us this investment return, it reduces the amount of borrowing costs to be capitalized. So you will not capitalize 84,000 because we had investment return of 13,000. So you take the total borrowing cost minus investment return. What you remain with is what is to be capitalized. And what is to be capitalized is taken to the balance sheet as part of the cost of the asset. So if I ask you for the cost of the asset, you take the cost of construction plus the borrowing cost to be capitalized to give you 770,500. Now, somebody was asking me, what about this 13,500? Eventually, it is the amount not capitalized. Amount not capitalized. Amount not capitalized. And therefore expensed. And therefore it will be expense. I believe I've answered all questions. Now, if we have 1,000 questions, we may not even move a single step. Sir, maybe you mistaken. So I think Donath have explained that. Please, Donath, just respond in the chat if you've understood my explanation. Where investment return affect income statement, I've told you, you will treat it as an expense because it reduces the amount to be capitalized. It reduces the amount to be capitalized. James, why are you multiplying by 9 over 12? James, I think I've explained why we are multiplying by 9 over 12. Vincent, because 300,000. Okay, thank you, Vincent. You are helping to explain. Fred, sir, how about period 1st October? 1st October to 31st. That period has already been accounted for here. Fred, that period of 1st October to 31st December has been accounted for here. Because here you took the whole period. You took the whole period. So it has been accounted for here. You can see 12%. You can multiply it by 12 over 12 to account for the whole period. Can we move, please, to asset B? Asset B. Now, in our asset B, I will repeat the same logic as this. So I'll just repeat the same process. Total amount of borrowing costs. Total, can you type for me in the chat? Total, can you type for me in the chat, please? We can just all chat. I'll just pick the responses randomly. Total borrowing cost. Type for me as I write. Borrowing costs to be the total borrowing cost. I need to see in the chat how much for asset B. Look at what we did in asset A. I'm giving you 30 seconds to type in the chat. What will we have in for asset B? I'll be giving you 30 seconds as I look at your responses. I cannot repeat if you joined late. You'll have to catch up from your friends, because if you joined late, Everybody who joined late will be returning me back. So I cannot go back to the beginning if you joined late. I would like to know the amount to be capital. No, I've asked a question. Okay, thank you. Thank you. 1.4 million times 12. I've got the response. So the total cost of asset B is 1.4 million. That is the amount that was borrowed for asset B. So you'll have 1.4 million times, thank you for your response, 12%. So that will give us 1.4 million times 12%. It gives you 168,000. 168,000. 168,000. And then you come and less investment return. Investment return. Again, 30 seconds. 30 seconds as I pause. What will be the investment return in this case? Type for me in the chat, please. What will we have? I'm waiting. Investment return. In the chat section, please. Thank you. 600,000 times 6%. But it is for 9 months. So it is 600,000. 600,000 times 6% times 9/12. Thank you for the response. So what will we have here? We have clearly said it's 600,000 times 6% is the rate of return times 9 divided by 12. So it gives us 27,000. So borrowing costs to be capitalized. To be capitalized. The amount of borrowing costs to be, just a second. The amount of borrowing costs to be capitalized will be equals to 168,000 minus 27,000. So it will give you 141,000. Okay, now we need also to calculate cost of asset B. Cost of asset B. We need to calculate the cost of asset B. Now, cost of the asset B is cost of construction. Construction, which is 1.4 million. And then you add the borrowing cost to be capitalized. Add borrowing costs to be capitalized. You add the borrowing cost to be capitalized. So the borrowing cost to be capitalized is that 141,000. So the total cost of the asset will be 1,541,000. 1,541,000. So what will this be? Total cost of asset B. Total cost of asset B. Now, this total cost of asset B, of course, is what you will take to the balance sheet. So remember, this goes to statement of financial position as non-current asset. And the same here. The same here. Goes to the statement of financial position as non-current asset. Now, in borrowing costs, the examiner can set different types of questions. So I'm looking at different possible scenarios, the different ways the question can be tested. So we have looked at the first way the question can be tested. We have solved that example. We have looked at an alternative way the question can be tested. Let's still look at more questions. I can leave out this as an assignment. Example 4. I can also leave these. I think I can do this. I can do this example 4. because example 3 is exactly the same as example 2. So I can do example 4. Now, example 4, it's a different set of equation. So let's understand the concept of the equation so that we may be in a position to do it. There will also be other additional questions. So the question reads, this one I picked it from the notes, but there is an example in August 2021, which is exactly the same as this. Only numbers have changed. August 2021 past papers, question number 3B. It is exactly the same as this. A question that is exactly the same as this one that we have done is April 2022. Sorry, April 2023. April 2023, question number 1 is exactly the same as this example 2. So the example we are trying to do in this case, a similar example was tested in August 2021. So what we are doing in this case, a similar question was tested in August 2021. So I'm doing what is testable, in short, or what can be tested. So let's solve these as we wind up. So the question reads, XYZ, please let's be attentive because this is again a different, completely different type of equation on borrowing costs. XYZ acquired a loan from 2 banks to facilitate the construction of investment property. I'm repeating, I'm reading here. XYZ acquired a loan from 2 banks. So this company acquired a loan from 2 banks. Please note that in your free time, you will practice the August 2021 question number 3B so that you can attempt a question like this. So this company borrowed a loan from 2 different banks. The first loan was borrowed from Bank A, and the amount borrowed was 360,000 at an interest rate of 10%. And for the second asset, they borrowed an amount of 240,000 at an interest rate of 12%. The company began the construction of investment property on 1st January 2006 using existing bank loans. 90%, so they used existing bank loan. 90,000 was withdrawn from the funds on 1st January 2006. And 100,000 was withdrawn from the funds on 31st September 2006. Now, this question has not told you where the funds were withdrawn from. You have just been told 90,000 was withdrawn from the funds at the beginning of the year, and 100,000 was withdrawn from the funds on 31st September. So that is 31st September. Now, you have not been told where these 2 sources of funds were got from, yet we borrowed 2 loans. So what we are sure of, it was part of these 2 loans, but we don't know if it was removed from loan A or it was removed from loan B. I hope we are together. We don't know if it was removed from loan A or it was removed from loan B. So whenever you have 2 different types of loans, you must calculate as an accountant what is known as average rate of the loans, because these are 2 different banks. So your first point or your first working is to calculate the average rate of the loan. Now, in order to calculate so that we have one rate for all the loans, the average rate of the loan is calculated as follows. It will be, carefully look at what I'm doing. It will be 12% times the amount that was borrowed of 360,000. You close the bracket, you add, sorry, 10%, not 12. We borrowed 10. The rate of bank loan A was 10%. For bank loan B, the rate was 12% times 240,000. divide by. Remember, what do I want to get? My objective in this case is to get, I'm just trying to expand the space. My objective is to get the average interest rate. You divide by the amount borrowed. The amount borrowed is 360,000 plus 240,000. When you divide it that way, that is when you get the average interest rate. So average interest rate, you just don't take 10 plus 12 divided by 2. Because 10 was for 360,000 and 12 was for 240,000. But if the two were for a similar amount, you can just take 10 plus 12 divided by 2. But if the amounts were different, you get the weighted average. Actually, it's supposed to be called weighted average rate. Weighted average. Let me write it there. Weighted average rate of the loans. Now, what is our weighted average? Let me do it. It is 10%. We have said times 360,000. We have said plus 12% times 240,000. Close the bracket. So the numerator is 64,800. The denominator is 360,000 plus 240,000. So the denominator is 600,000. So what is our rate? Our rate will be therefore be equal to this divided by that. So as a percentage, it will be 11%. Maybe let me round it to one decimal place. As a percentage, the weighted average will therefore be 10.8. So take note of the 10.8. It will be 10.8. So this is the weighted average. Now let's move to number 2. We have known the average rate of the two loans because loan A carried a rate of interest of 10%. Loan B carried a rate of interest of 12%. Next, we need to now calculate the total borrowing costs. Total borrowing costs. Total borrowing costs. I'm just trying to be very systematic and very slow here. Total borrowing cost, there was for loan A. Borrowing cost for loan A. For loan A, it's equals to 10% times the loan that was borrowed, 360,000. That is for loan A. For loan B, the amount that was borrowed was 12% times 240,000. 240,000 is the amount that was borrowed. So the total interest that you will pay to the bank, to bank A, you will pay 10% times 360,000. To bank B, you will pay 12% times 240,000. So what is the total? That gives us the total amount, the total loan borrowed. So the total loan borrowed is therefore equal to the total interest paid on the loan borrowed. In other words, the total borrowing costs. Just hold on, I make it doable a bit. Okay, so the total loan borrowed is this. The total borrowing costs, in short. Total borrowing costs for A and B. For loan A and B is that. However, we need to calculate, I'm trying to be systematic in this question. We need to calculate borrowing costs to be capitalized. Remember, each question is unique. I've given you 3 different types of question. Capitalized. Borrowing costs to be capitalized. Please, let's be attentive here. What is the borrowing cost? The total borrowing cost is 64. Sorry. The total borrowing cost is 64. But now here, if the total is 64, I now need, when there is an average interest rate, I need to calculate the borrowing cost to be capitalized. When you want to calculate the borrowing cost to be capitalized, when there is an average interest rate, you read this information here. The company began construction of investment property on 1st January 2006 using existing bank loan of sorry, I've read it wrongly. The company began construction of investment property on 1st January 2006 using existing bank loans. 90,000 was withdrawn from the funds on 1st January and 100,000 was withdrawn from the funds on 31st December. So from 1st January, the amount withdrawn was 180, sorry, the amount withdrawn was 90,000. And then the average interest rate. What have I done here? Did I interfere with the formulas? What did I do? Okay. I know what happened. So we had that. Okay. So the average interest rate, I was looking for it and it was missing. That's why I've gone back. So the average interest rate was 10.8%. So what does it give you? And this was for 9 months times 9/12. Why 9/12? It just happens that all my questions I've selected, they are ending on September 31st. So what is for borrowing costs? And then there was another one from 1st October. 31st September is the same as 1st October. 1st October, we used 100,000 times the average interest rate, because we were not told where the loan was picked from. And this was for a period of 3/12. So what is the total borrowing cost? It is 90,000, the amount that was used, times 10.8% times 9 divided by 12. And for the second one, it is 100,000 times 10.8% times 3/12. It gives you that. So the total borrowing cost to be capitalized, total borrowing cost to be capitalized is equals to, so we just add those two. The total borrowing cost to be capitalized is equals to now finally, number 4, total cost of people. Okay, maybe we can even add borrowing cost to be expensed. Borrowing costs to be expense, because it's only fair if I've calculated the one to be capitalized, it's also good to calculate the one to be expensed. Borrowing costs to be expensed. So borrowing costs to be expensed will be the total borrowing costs. Look at this. It will be the total borrowing costs. Let me bring it down here. Total borrowing costs is 64,800 minus what was capitalized, 9,990. So the total amount to be expensed, it is the total amount you remove what was capitalized. So that is the total borrowing cost to be expensed, in case the examiner asks you that. Finally, total cost of the asset. Total cost of the asset. How much so far has been used? So it will enable us to calculate the total cost to be, so cost of construction. Cost of construction, we have so far only used 90,000 plus 100,000. So 90,000 is here. What was used in construction on 1st January and what was used on 1st October or 31st September. So the total is equals to 90,000 plus 100,000. Plus you add the amount capitalized. Borrowing cost capitalized. So if you add borrowing cost capitalized was 54. Sorry, not borrowing cost to be capitalized was 9,900. So this is the total cost of the asset. Total cost of the asset. Now, in summary, what are we trying to say? Let me add this. Now, this is what goes to the balance sheet. Goes to statement of financial position as non-current asset. So in summary, as we wind up, we have looked at 3 examples. The first example was just looking at the costs. There was no investment return. The first example was only looking at prorating. Construction started on 1st January and it ended on 30th September. So it was only looking at when does capitalization stop. The second example was looking at how do we account for borrowing costs when there is investment return. That was example 2. The last example we have looked at is looking at how do we account for borrowing costs when we borrow loans from different banks. So the 3 examples are completely different. This one looks at how do we account for borrowing costs when we borrow from different banks. This one looks at how do we account for borrowing costs when there is an investment return, when we invest part of the proceeds. And the first one looks at when does capitalization stop? When does capitalization stop? When does it stop? When does capitalization stop? So in summary or in conclusion, we are trying to say as we reach the end of our presentation, borrowing costs, you should know what borrowing costs is. Recognition of borrowing costs. We recognize borrowing costs. Number 1, for qualifying assets, we capitalize borrowing costs. For non-qualifying assets, we expense. And then we have said, in borrowing costs, you need to know when does capitalization start, when expenditure on the asset is being incurred. Number 2, when the borrowing cost is being incurred, you have already started paying the loan. Number 3, when activities intended to prepare the asset for its intended use are in progress. When does borrowing costs stop? Number 1, when construction is suspended. Number 2, when construction is complete. And then finally, we said that if there is any investment return, the amount of investment return reduces the amount of borrowing cost to be capitalized. That brings us to the end of the standard. Tomorrow, I'll communicate to you how you can get the recording also. But always attend the class so that you get it real time. I'll advise you tomorrow how to get the recording for those who are interested. And also the Excel sheet, I'll share them tomorrow. So, okay, somebody's saying, check the question. They said 100,000 have been withdrawn by 31st September, which means the other 90,000 have since been, no, that is a different, Jocelyn, it's a different set of a question. In this question, the objective was only to look at how to account for different loans. Okay, so where does the 3 over 12, I think I've explained 3 over 12, it's from October to December. I'm trying just to look at the question. So this means that the funds withdrawn are the only ones that we use. Yes, the funds withdrawn are the only ones that we use. I'm just trying to read the questions randomly. That brings us to the end of this session. Unless there is a further question, I'll bring the session to an end, and I will share the recordings. Thank you. Have a good night, and thanks for attending the session. We can end the session at that.